one. And welcome everybody to another Smart Money Circle show. I'm very excited about today's guest. Her mission is to empower women and educate them on how to make smarter and better investments. Nancy Tengler is the guest today. She's a CEO, the Chief Executive Officer, and the CIO, the Chief Investment Officer at Laffer Tengler Investments, with $1.2 billion in assets under management and growing. She launched a new ETF recently. The ticker symbol is TGLR. Nancy, welcome to the show.
Thanks so much for having me, Adam. I really appreciate it.
So Nancy, I always like to begin. Can you tell us your story and how you got to where you are today, please?
Yes. Well, I grew up in a single parent home. My mom worked 2 jobs, so we had to start working when we were very young. And it was the 70s. So if you think right now is bad, the 70s were 5 times worse. High inflation embedded in the economy, unemployment rates super high as opposed to current levels. And so, I did what I could, right? And I became focused on how to save. And then ultimately that taught me or led me to how to invest. I've never met a wealthy person who became wealthy investing or savings alone. It's always involved investing, whether it's in stocks or real estate. And what I've learned over the years is that women have kind of excused themselves from the conversation. So I was in the investment management business from the early 1980s till about 2003 or 4. And then I left, got a graduate degree in creative writing of all things. And now I'm back. But in the meantime, I met all these super smart women that had MBAs from Berkeley, a periodontist, a lawyer, a rodeo queen, and none of them were engaged in the process. In fact, when they asked me what I used to do and I told them, they would kind of recoil. And say, yeah, my husband takes care of that, or I don't get that. It's like a game, and investing is anything but a game. So it really focused me on writing the Women's Guide to Successful Investing, and now the second edition is coming out in a couple of weeks.
Congratulations. That's a really, really great story. And I want to ask you about the book a little bit later in the show as well. But before we get there, can you tell us about your investment strategy, please?
Yeah, so I was fortunate to be mentored before we knew that this person was a mentor in that 1980s by a guy who had developed a strategy called relative dividend yield. So it's a value approach to investing. But at that time, investors were only engaging in low price to earnings or low price to book as a metric. Relative yield is compelling and interesting because managements and the board set the dividend as a portion of what they think long-term sustainable earnings power is. They don't want to have to cut the dividend. So while earnings estimates from Wall Street analysts are wrong about 2/3 of the time to the upside and the downside, the management team is mostly right. And what we figured, especially back then, when we used to get your reports in the mail over a 3-week period, what we determined was that we would go with management and that we got great insight. Plus, we got a growing dividend, and we got a metric that allowed us to really identify periods of over and undervaluation. Still using it, still works. The strategy has very high ratings from all the independent rating firms. So we're really happy and proud of the work we've done.
I love it. Nancy, just to help educate the audience a little bit, which I know is one of your passions and mine as well, because the whole point of the show is a timeless advice. And can you tell us again the name of the strategy, the dividend yield?
Yeah, so it's what we're offering in TGLR, and it's called relative dividend yield. So we're looking at the stock's yield compared to its own history and then compared to the yield on the S&P 500. And what you see are these really beautiful periods, well, beautiful to me, of overvaluation when the relative yield is low and undervaluation when the relative yield is high. Classic example, we were buying Apple in 2013. The yield on that stock, if you can believe it, was 3%, it was just under 3%, which was higher than the 10-year yield at that time. Everybody wrote the company off because Steve Jobs had passed away. It was just a handset company. That was the knock. And Tim Cook was no Steve Jobs. Well, 5-fold return later and a yield of about 0.6, we've been forced to trim our holdings initially and now start to sell out. But that's a victory. That's what relative yield brings you. Fallen angel growth stocks. This is not an electric utility strategy or a REIT strategy. We don't even own any electric utilities. We're looking for dividend growth in fallen angel growth stocks.
Understood. Well, thank you for educating us. That was my next question. Can you explain the strategy? So you're looking for stocks that are fallen angels, meaning they're out of favor. They've fallen for enter any reason you want. It doesn't matter. But you know that their yield is growing, their dividend is growing, and they've got good earnings power because management believes in it and they've set their yield.
Right.
And from that metric or from that point of view, you can look to see if a stock is overvalued or undervalued relative to the S&P. Is that a good way of summarizing it?
That's perfect. Yep.
Okay,
Yep.
excellent. So let's talk about risk. Nancy, how do you handle risk and what mistakes do you see people make with respect to risk management?
So risk management is probably the hardest part of our job because as a value investor, your instinct is to buy more when a stock is down. But oftentimes that leads you to owning what we call terminally cheap stocks. Other people call them value traps. So what we do, and I write about this in the book because it is accessible to every person. The amount of free research is incredible. I mean, stuff people get for free, I used to pay $500,000 a year for. But we have what we call the 12 fundamental factors. So 9 of those are quantitative and they're just facts, price to book, what's the debt to equity ratio, how fast are they turning over assets, things that matter to people that are in the weeds. But the 3 qualitative factors are the ones that really matter. The top one is management. So when you get a new management team, that's a time to step back and reflect and look very closely at what they're doing. A great recent example was Starbucks. Howard Schultz had to come back for the 3rd time. And, we had already exited because the stock had appreciated into our sell range. But I watched the new CEO, Laxman, and he's the right guy for the job. And so we reinitiated position and we're adding to it based on what we've seen from him, the levers he's had to pull, and the catalysts that are going to drive. That's one of the other factors, catalysts. What's going to make this thing outperform? Just being cheap is not good enough. Right. And in the book, again, I talked first edition about Coach. Should you or shouldn't you? And Nordstrom, should you or shouldn't you? And we decided you shouldn't based on the 12 fundamental factors. That turned out to be a really good decision. I've gotten many wrong, so I'm not going to just talk about the ones I've gotten right. And in the book, I do talk about things that I've gotten wrong to the point that you're probably going to go, why am I reading this book written by this woman who's wrong?
Make so many mistakes, right? Well, that's how you learn. Yeah, that's exactly how you learn. I've made every mistake under this. I tell people, Nancy, I'm lucky if I can tie my shoes.
Well, I used to manage money for the Bechtel Corporation, and that's a collection of engineers. And so I was at one meeting and I said, investing is about being mostly right. And you could hear the audible gasp because you can't build a bridge by being mostly right. But anyway, you're absolutely correct. You do make mistakes. Everyone makes them, and it's good to talk about them and learn from them.
Okay, so I'm going to go off on a tangent here for a second, but my wife is a chemical engineer and my father-in-law is a nuclear engineer, so PhD kind of a guy. So the whole family is very 1 + 1 = 2, and my whole world is the exact opposite. So right. I understand exactly what you're talking about.
Oh,
okay.
Yeah, that was a hard place for me.
It's no joke. Okay, let's before we move on, let's talk about risk. So you want to make sure you avoid the value trap or avoid buying terminally cheap stocks, meaning they don't go up. Do you have stops in place, or how do you know when the thesis is just wrong and you need to exit? Is it a % change from entry, or is it some other factor that you look at for risk management?
I know there are people that do stop losses and say, okay, at 25% down or 20, whatever their number is, we're going to exit. For us, it's more about we sit on every earnings call and we listen to management. We do assess the 12 factors frequently. So it comes down to more of an instinct, or when we've owned a stock and we've owned it for a couple of years and there's no progress, then we have to conclude that there is no catalyst for growth. I mean, we make sure that's correct, but we've exited a number of stocks recently, or in the last year anyway, where we thought the premise was A and it wasn't. So think of a name like CVS. The model's just not a great model. They paid down debt, so that's when we got in, and then they made another series of acquisitions. The debt rose again. They're not going to be able to increase the dividend. It's even questionable if they'll be able to maintain the dividend. So we got out and the stock has disintegrated. I mean, we took some of it, but that's the hardest part, is that you've got to know when to I call it the opportunity cost question. What are there better places to be? And frequently, and particularly in this market, surprisingly, there are much better places to be. We also exited Corning. The thesis is great. They build the screens. Everybody's using screens in their Teslas and in their Apple phones, but iPhones. But in fact, the company has been unable to grow in any meaningful fashion. So I might be wrong, but I found a much better place to be in Emerson and Carrier and some other names like that.
Nice. So on a question, go back to relative dividend for a second. Do you only buy stocks that have a dividend, or are you open to buying stocks without a dividend?
So in TGLR, only a dividend. They have to pay at least a market yield. We also have a growth strategy. And for that, we use relative price to sales ratio. So we were trying to find a metric that was equally as reliable as the dividend. And it's not earnings, because you can drive a truck between GAAP and pro forma earnings, but it was indeed sales. What are you paying for a unit of sales? If you manipulate sales, you hopefully go to jail. So we have found that to be very reliable. It's relative to the stock's history. So what have I paid for a unit of sales historically? And then against the S&P, because that's the ultimate benchmark. And that's led us into some really compelling names. Some of them do pay a dividend, most of them don't. So think Lululemon, Chipotle, ServiceNow, Palo Alto Networks. So it's a higher octane portfolio. We manage risk by how much exposure we have to an individual security and then how much overweight our portfolio is relative to the sector weightings in the S&P. And we do that.
That makes perfect sense. Okay, understood. No, that makes perfect sense. Okay, let's talk about your book. So your book is fantastic. I know you're an advocate for financial literacy with women. And for anyone that doesn't know, you can just go on Amazon and type in, the name of the book is The Woman's Guide to Successful Investing. I strongly recommend it. There's another edition coming out too, which I'm sure is a labor of love, but it took me 5 years to write my book. So I fully understand and appreciate what an author does, especially a money manager slash, now an ETF person. So you've got a lot into it. Here's my book. It's Psychological Analysis. So, so my whole thesis is that fundamental and technical analysis is not enough to beat the market. If it was, everybody would own a few islands in the Caribbean. So there's a third element, and it's thyself. It's know thyself, master thyself. So a lot of the cognitive biases, the whole idea is to learn how to make rational, not emotional decisions with your money. But I'm really interested.
That's so cool, Adam.
Thank you. I'm really interested, Nancy, to hear about your book. And if we can go share as much as you want with it, with the audience. I'm passionate about educating people for investing, so I'd love to hear what you have to say, and I'm going to be taking notes. So by all means.
Oh, well, thank you. So I guess, as I mentioned, I met a lot of smart women that were not at all engaged in the process. I still meet women where they don't even know the password to their accounts. So the problem with that, Adam, is that the average age of a widow in the United States is 59 and a half. I was 59. It's way too young. And I was fortunate because I managed all the money and I, paid the bills, et cetera, but it was still just a colossal upheaval. There are a lot of things that still aren't right. Like I can't get AT&T to change the name of the bill. So I have some pointers in the book on just things you should be thinking about. But then the average age of the first divorce is 30. And so for many years, I wrote a column for USA Today. And the first column what I wrote, they put the headline, "You just got married, now get ready for divorce," which was a little bit overwhelming for me, but it got a lot of hits, and the data was important. So you've got women getting widowed at 59-ish, first divorce at 30-ish, and then we live longer. So this transfer of wealth is happening, and women are taking on more and more wealth. But what also happens is they usually don't have a relationship with their advisor. It's usually with what we call the money spouse. And so, and that's typically the man. And so what ends up happening is women end up firing their advisor to the tune of almost 2/3. And that becomes very expensive, because you have taxable gains, you have to transfer the assets. It's just an expensive process. So I'd rather see women maintain or develop a relationship with their advisor and then stay where they are if they're happy. And that's not happening. And then the last thing I'll say is that, I'm a baby boomer, and we tend to be a little bit more involved in the process. Maybe it's just because we're older, but millennials are deferring to the money spouse at a much greater rate than the baby boomers. So the trend is not moving in the right direction.
Got it. No, that makes perfect sense. So let's shift a little bit now and talk about some timeless lessons you've learned along the way. I know you have a lot. Anything that you want to share with the audience about life or about markets or about business or about any of the above, by all means. We'd
Well,
love to
I
hear.
think the most important one is from Peter Lynch, and that's don't let the market scare you out of stocks.
Mhm.
I participate in the financial news media. I'm sure you do too, and you know that what happens is they start the day with a reading of the left-hand column in the Wall Street Journal, and then that's what they talk about all day. And there's nothing wrong with that, except it builds this kind of momentum on good news and bad news. So I think one of the first and foremost things is to not listen to the people in the near term that are telling you we're going into a bear market, you need to sell your stocks, because nobody really lives that way. If you
Right.
have taxable assets, you're not going to take those gains, pay the taxes, and then know when to get back in. There's a lot of research that's been done of the fact that many strategists get one of the entry points, either exit or entry points, right. They almost never get them both right.
Right.
And that's so that's a problem. And so we want to encourage people, it's time in the market, not timing the market. And there's a lot of data that shows if you miss the 5 best days, you end up giving up the majority of your total return over the long term, and it's meaningful.
Yeah.
So that's one thing. And then the second thing is I would say is for women to engage, ask questions. Our business likes to make the narrative kind of esoteric and sound really smart, but it's just basic. Stocks are a claim on real assets, and they're not a mystical piece of paper, and earnings matter. So if you understand the basics, and I do a lot of that in the book, where I talk about, like when you buy a house, you look at price per square foot. What
Right.
influences that? Location, granite counters versus linoleum, like I have here in Tahoe. They're retro, let me just say, wood grain Formica counters. But you look at all sorts of things, the school district, and so a company's the same way. And so that's what the price to earnings ratio is. It's telling you something about what the market thinks this stock is worth relative to its peer group, and the same with relative yield and all the metrics. So I really try to use real examples that are not at all condescending. This isn't pink checkbook covers like a lot of the bank, they have women events, and they do mani-pedis and drink wine. But we're trying to educate women and really have them leave in a better place for their future, because they're probably going to own the assets at some point all by
Yeah.
themselves.
That's really, really powerful. Now, what are some timeless mistakes you've made or you've seen people make, and how do you recommend to avoid them?
So my favorite is the tip, right? So I'm on a plane. These guys are doing an IPO. They're at the end of their hoo-ha, where they talk up the company. And I'm listening, and we're drinking, and I'm thinking, this is a great company. And the company was called Smart Card. And it was a telephone card that came out right before we all switched to cell phones. So the thing went like up and then down. It got delisted. So that was one. Then the next tip was from a guy I worked with in Switzerland, and he made so much money on this biotech company. It was trading at $10 a share. So I bought it. It went to 2. The third tip I got was from Ron Barron, buy, I just forgot the name of it. Win. And this was like in the, the single digit or low double digits. I was like, I'm not falling for that again. I didn't buy it, and I left a ton of money on the table. So that was my lesson. Don't buy what you don't know, and make sure you understand the business, what the company's doing, what the history is. It's not that hard to find out. It's actually quite simple. All the data's online. So that's my first and foremost.
No, I love that. So basically, don't listen to just random tips. Do your research, and like Peter Lynch says, buy what you know, buy what you love, type of a thing.
That's right. That's right,
Yeah,
Adam.
I love that. Okay, what about the best piece of advice you'd like to give to the audience or to your 30-year-old self?
Yeah, so I got it from a client that I managed money for in New York. He asked me to call him. He gave me $3 million. I was probably in my 30s. I don't know why he gave it to me, but and then the idea was that I'd call him every month and we'd talk about it. So I'd start out every month. Well, Mr. Z, your portfolio is up blah percent versus the S&P, and he'd listen for a few minutes and he'd go, Nancy, how much money do I have? I gave you 3 million. How much do I have? And
Right.
really, that was probably the very best advice I ever got. is that most investors are not trying to beat an arbitrary benchmark. And in fact, the research shows, and it does show this, if there's now more than one study, there used to only be one, that women actually make better investors than men because we do more research and because we're not chasing some benchmark and really trying to, outperform. So that was fantastic. And then there was a second one that kind of fit in with that, another extraordinarily wealthy family in New York. They made their money selling bonds to investors. He shows me his portfolio as he's interviewing me, and it's concentrated growth stocks. And he goes, "Yeah, you're kind of surprised," but they were legacy assets for him. And so he was investing those assets for a different time horizon than his own retirement. And that focused me on concentrated portfolios, which I think is the only way to beat the market. And so we run concentrated portfolios, 20 to 30 stocks, and then we have a 12 best ideas portfolio. And those, I mean, if you don't have enough conviction to own at least 2 or 3% in your portfolio, you have no business owning a stock.
Yeah, no, that's really, really, really powerful advice. I love that. Just show me the money. You're talking about all this other stuff, but the one thing that the guy cares about, which is his bottom line.
Right.
So yeah, that is so powerful. Well, Nancy, thank you so much as always. What is the best way for people to get in touch with you? We have ticker symbol TGLR, which is an ETF that you just launched alongside Matt Tuttle and Tuttle Capital.
Yes.
Outside of that, what's the best way for people to get in touch with you?
Yeah, so our website is pretty interactive. It's laffertengler.com. There's a link to the book. There's a link to the ETF, and it takes you to the ETF website. I think first and foremost, we also write what we call our research bulletin every couple of weeks. And you can subscribe to that on the ETF website or on ours. So it tells you what we're thinking about and gives, some data on markets and commodities, but also specific stocks.
Beautiful. Well, Nancy, thank you so much. And hopefully we'll have you on again soon. And good luck with the book.
Thank you, Adam, so much.
Thank you. Thank you.